The natural-born investor is a myth. One of the wisest words uttered by one of the greatest and most inspiring investors of all time, Peter Lynch. Hey there guys, how are you doing? And welcome back to another video on our channel. Peter Lynch is a man who needs no introduction. His success speaks for itself. If you want to be successful like him, then here is Peter Lynch's golden rules of investing. Investing requires work. This rule is for those who think that investing is like casting a magic spell. Many investors just sit back once they've invested. If investing was that much of a piece of cake, then everyone would be a millionaire by now. Have you ever wondered why there are more losses in the stock market than success stories? That's because people go by wild guesses instead of careful evaluation. So what you need to do is keep a track of your investment, and it's no joke. You have to work for it. This is just one of the many rules to make sure you're going in the right direction. But before we go any further, do be sure to give this video a huge thumbs up, subscribe to our channel, and hit the notification bell to get more video updates like this. Now let's carry on. Never invest in this kind of idea. According to Lynch, never invest in any idea you can't illustrate with a crayon. Let us break it down. If you meet someone who runs a successful business and ask them about their business, they'll be able to explain it very easily. In other words, their explanation would paint a picture of their business right in front of you as if they were drawing it with a crayon. What does that tell you? A true business understands the business he owns. So if you're investing in an idea, make sure that you fully grasp it. The rearview mirror doesn't offer you a full picture of the future. You can't see the future through a rearview mirror, says Peter Lynch. Looking at the past performance of a certain company is an important part of investing in it. It will help you understand the progress of the business. Even though it's a crucial step, it's not enough. For instance, if a company had excellent growth overall, but it has been facing issues recently, then in that case, the company is a bad investment. Even though the past was bright, the uncertain future remains dark. So seeing through the rearview mirror is significant, but you have to look at the future as well. To do that, you must keep your eyes on the front road as well. Predicting the economy is impossible. The golden rule of Peter says, nobody can predict interest rates, the future direction of the economy, or the stock market. Dismiss all such forecasts and concentrate on what's actually happening to the companies in which you've invested. The economy is never constant. It keeps changing, so you can't predict it. So don't try to control what's not in your hands. Instead, focus on a company's performance. The best stock is the one you own. The best stock to buy may be the one you already own. Once you've invested in a stock, then believe that that is the best one for you. Try not to run in different directions and search for better investment opportunities. If you do that, you'll end up with nothing on your hands. Invest in small cap companies. Peter says, with small industries, you're better off to wait until they turn a profit before you invest. If you compare large cap and small cap companies, then small cap companies have the potential to earn greater returns for you. The reason for that is small cap companies have much room for growth, while the latter is usually at the mature stage. See the stock market decline as an opportunity. A stock market decline is as routine as a January blizzard in Colorado. If you're prepared, it can't hurt you. A decline is a great opportunity to pick up the bargains left behind by investors who are fleeing the storm in panic. In stock markets, anything can happen. The chances for hefty profits come with a risk of downfalls as well. Don't let situations let you down. See the stock market decline as an opportunity to buy more stocks at a discounted price. Invest in companies that fit your growth criteria. If you can't find any companies that you think are attractive, put your money in the bank until you discover some. Don't rush to buy stocks. Don't invest just because you want to at any cost. If a stock doesn't match your growth criteria, just leave it. Every investor must know when it's not the time to buy a stock. Don't own stocks more than you can handle. Every investor should know that owning stocks is like having children. Don't get involved in more than you can handle. The part-time stock picker probably has time to follow 8 to 12 companies and buy and sell shares as conditions warrant. There don't have to be more than 5 companies in the portfolio at any time. If you've invested in multiple stocks, then remember that all of them require different attention. So if you can't handle multiple stocks, then don't wander in different directions. According to Peter Lynch, if you invest $1,000 in stock, all you can lose is $1,000, but you can stand to gain $10,000 or even $50,000 over time if you're patient. the average person can concentrate on a few good companies while the fund manager is forced to diversify. By owning too many stocks, you lose this advantage of concentration. It only takes a handful of big winners to make a lifetime